All right, so last week we started talking about mutual funds. And if you want a refresher of what a mutual fund is, you can watch the previous video. And we started talking about the different type of mutual funds that are available inside the 401ks. So we talked about the income fund or stable value fund. We talked about various different bond funds. We talked about the balance fund. So now let's go into the actual stock-based mutual funds. All right, so the most common ones that you're going to see are called large cap. So meaning large capitalization. The mutual fund companies, if you remember, it's like a pie. Okay, there's a whole bunch of different investments or different ingredients that they use to make the pie, different investments that they use to make the mutual fund. So it's not one company, it's multiple investments, it's multiple companies. So, and then the mutual fund company packages it all into one investment or one pie. Okay, and then you as the investor get to take a slice of that pie, and you don't own any one individual investment or one individual ingredient from the pie. You just own the slice of pie as a whole. Okay, so large capitalization, meaning if you were to take the value of a company, so if you were to take the stock price of a company multiplied by the amount of shares that are, out in the market, okay, then you have the market capitalization. So the large capitalization or large cap mutual funds, what they're going into, they're only investing into companies that are worth billions of dollars. Okay, so things like Google, Walmart, Apple, Bank of America, JP Morgan Chase, Netflix, Facebook. So all these different types of companies, that's what they're investing into. And there's different categories, and these categories that I'm about to go over with you apply to across the board in all the sectors for mutual funds. So once you get more familiar with these terms, you're going to be able to apply it towards other categories within the mutual fund universe, and you'll understand what it is that they're investing into or how, some of their strategies that they're taking. Now, again, these videos are not designed to go in super in depth. This is just going to be a really high overview, so just keep that in mind when we're talking about this. All right, so large cap, there's growth, there's value, there's blend. So let's go over these, okay? So we're going to go over the value strategy first, and that's what they are. This is a strategy that the mutual fund company is using when they are creating these mutual funds, okay? So the large cap value, when you see that, the investment strategy that they're taking is to go after companies that they feel are undervalued, okay, and invest into them. And there's several reasons why they would do this. So let's talk about why they would do it. The stocks have a book value. Just like a car has book value, stocks also have a book value. Now, if a stock is trading below book value, it's a bargain, right? If you found a car that was, selling below book value, it's a good deal, right? Depending on the condition of the car. Same thing with the stock. Depending on the condition of the company, it can be a good value. So if the company is selling below book value, it doesn't automatically mean there's financial distress. Again, it's kind of like the high income funds or high income bond funds. Just because a company has junk rating doesn't necessarily mean that it is in financial distress. There could be a whole host of reasons why a stock could be trading below book value. So the mutual fund company looks at the stock that they're going to invest into. And of course, they analyze it and do their due diligence. And then if they find that it's a good value, then they're going to go into it. But these companies, one of the things that's pretty common among these value companies is that not only are they trading below book value, but because they're trading below book value, they usually pay out dividends to their investors. So dividends, basically, it's basically the quickest way to describe it. It's a bribe for you to hold their stock. So they're going to pay you cash for holding their stock. And then you get to keep that cash whether the stock price goes up or down. You get to keep the cash. So, so it's considered a less of aggressive approach than like the growth strategy. And I'll go over that in just a second. That's not to say that that value mutual funds or value stocks are not aggressive. They are definitely aggressive and open to market volatility. It's just that that strategy for mutual funds is considered less aggressive than the growth. So let's talk about the growth stocks and growth strategies, and I'll tell you why it's less aggressive. So the mutual fund companies, when they're going after growth stocks, what they're doing is going after companies that are trying to grow their company, expand it, you know, come out with new products, and expand their R&D. So instead of this company, you know, paying you out dividends, they're going to take that money and reinvest it back into their company to grow it, and then therefore hoping to push up the stock price that way. So that's how a growth strategy works. Again, this is a really high overview. So why is that considered more aggressive than value? Well, in the value stock strategy, you're going to get the cash, and you get to keep the cash regardless of what the stock price is doing or what the company is doing, right? But in the growth strategy, if they're taking that money and they're not paying it to you and they're reinvesting it back into the company, there's no 100% guarantee that that investment, that cash that's getting reinvested into the company is going to yield a return. What do I mean by this? So I hate to pick on Google, but because I love that company, but I'm gonna have to use this example. So who remembers Google Glass? If you don't remember, there's a reason for it. It was a pretty big flop for Google. They had spent millions and millions of dollars on the R&D and product development and manufacturing and actually pushing it out to the public, and it was not well received. It was really quite a big flop. And so this is what I mean by just because a company takes that money and reinvests it back into, you know, whether R&D or new products or whatever, just reinvesting back into the company, it doesn't mean that you're going to get a return. So this is why it's considered, growth is considered to be a little bit more aggressive than value, because that money that gets reinvested back into the company doesn't necessarily mean that it's going to yield a return. So that's what I mean by that. Blend. It's just like it sounds. It's a blend of those two strategies between value and growth, okay? So that's all that is. So when you see those terms in your 401k, now you have a better understanding. Again, this is a really high overview of these funds, but at least now you have a better understanding of what it is that you're looking at. Now you're going to see like mid cap and small cap, and you're going to see again like mid cap growth, mid cap blend, mid cap value, or small cap blend, or small cap growth, small cap value. Okay, the mid cap or small cap, that's referring to the market capitalization. So mid-size capitalization or middle capitalization. So these are going to be companies that you may or may not have heard of, and then they have the different strategies, growth, value, blend. If you see small cap, these are not going to be companies that you're familiar with. Most of them you're never going to have heard the names of. They are not startups, but they are not big corporations either. And so they tend to be the more aggressive out of the three different categories of large cap, mid cap, and small cap. Small cap is the most aggressive because these are going into companies that have more restricted access to capital, and they are more volatile, up or down. when the markets are going down, they are usually the first ones to fall. But when the markets are going up, they're also usually the first ones to come back. So just keep that in mind when you're looking at these funds and you're trying to decipher how you want to set your portfolio allocation, if you want any of that exposure in there, if you've got the risk tolerance for it. So, but they are very aggressive, so be aware of that. Most of these, the mid cap, the large cap, mid cap, and small cap, unless otherwise noted, most likely are going to be domestic, meaning they're all just investing within companies within the US, unless they specify that they are, heavily investing into international waters, they're most likely going to be domestic. So again, this is just a really quick overview, high overview of just mutual funds in general. But now you're going to have a better understanding of what you're looking at when you are, looking at your 401k options. So that's a good thing. Yay. All right. And as always, if you guys have any questions or any topics you would like me to cover, go ahead and put them in the comments below. And as always, go ahead and hit the subscribe button. And I will see you guys next week.